bull run starting 2009, okay? So that's the good part of it. The sad part of it is, unfortunately, that there are some unsustainable statistics. Statistics suggest that the strong run we've seen is not going to be sustainable for too long. There must be a pullback at some point, just like we saw during this period. There are periods of bull runs followed by leveling off in the stock markets. So we can expect a leveling off in the stock markets for the next couple of years. Now, these statistics actually support that. We can see why stock markets in Malaysia have been very strong. Liquidity flows are terrific. In 2009, the ratio of the most liquid form of money to our GDP reached an all-time high. It spiked up very sharply, and that is the main explanation of why the stock markets did very well. We can see that what happens whenever there's a spike in the ratio of M1 to GDP. Whenever that happens, you can see how stock markets perform. In 1993, this happened. A sharp rise in M1 to GDP ratio, and we had a bull market in 1993. So similarly, the last couple of, within the last year, we had seen this kind of a spike. And that's, of course, taken the stock markets into bull run. Can this spike in M1 sustain? Now, the answer is probably not, because I've always been using this rule of thumb. The M1 ratio, typically the M1 growth cannot sustain beyond 20%. Every time it goes to about 20%, that typically marks some correction in the stock market. Where does it stand right now? It was in November, which are the latest statistics, it stood at about 13%, just over 13%. And at the rate it's climbing up, it will reach 20% in about February or March. And that's possibly a time when we could see a bit of a correction in the stock market. So the message I will deliver to you today is be mindful of the possibility of a correction in the stock market in February or March, because we are again approaching 20% annual growth rate for M1, okay? So that flags out some risk in the months ahead. Liquidity in the local environment has been supported by bank lending growth. You can see the correlation between bank lending growth and growth in Malaysia's foreign exchange reserves. This is coming out. Every time in the past the reserves start climbing, you can see this circle area, the bank's loan growth also pick up. That comes from the natural expectation. The banks receive a lot of deposits from accumulation of foreign exchange reserves. What do? They lend them out. So we've seen that happen again in 2007. Nice run of growth in reserves and nice growth in bank lending. So right now the year-on-year change in reserves is again climbing up, and I expect bank lending to start climbing up again. From a base of about 7% growth, annual growth in the month of November, I expect it to start climbing up again. And that's the primary basis of one of our the sectors that we're more optimistic about, which is the bank sector. The one question that we're all trying to address is how much room is there for more rise in the stock market? Now let's try to look at history as a way of trying to assess the future. This is a plot of how stock markets performed in the last four, should I say five? 1, 2, 3, 4 bear markets. And the 1981 to 82 bear recession, you can see that the country stock market went into a bear market, and then it staged a recovery. So the current recovery is the one in red here, and it is in terms of appearance or timing, it looks to be most similar to the recovery from the bear market of 1981 to 1982. The slope of the ascent and the period over which a bull market developed is about the same. But then that analogy also creates some problems, because right now where we are is approximately the time when, during the 1981 and 1982 rebound rally, the stock market rally ended. And we're about that time. We've approached approximately that time. Okay. What happened in 1981 and 82 after that rebound rally? The stock markets went into decline. For some of you who are veterans in the stock market, you remember the Pan L crisis in the mid-80s, property market bust. That took the stock market all the way down into 1985. Are we going to see the same? Are we going to see the stock market level off? Will it continue to climb? And that's a question that we have to address. Now, the view that I prefer to adopt right now is, yes, we'll see a small correction in the stock market, something of this nature, perhaps 10%, maximum 15% kind of correction, and the stock markets will probably level off from here. So in the next couple of months, 6 months ahead, the picture seems to be most likely it will level off. Valuations-wise, the numbers do support a leveling off in the stock market. The PER's price-earnings ratio, which is the simplest and most easily understood form of valuation, approach to valuation. The valuation stood at very high levels of more than 17 times the earlier part of last year. You can see that that 17 times seems to provide a cap on the stock market's gains. In 2007, you can see that caps of around 17 to 18 times PER appear to have held very well as well. Right now, by the way, the black line is the dark brown line is the historical PER or current year PER. The gold or yellow line is the one for forward PER, next year's earning, the forward 12-month earnings. The estimates are that the PER currently stands at around 14.0 times, which is not expensive in traditional valuation terms. 14 times PER is not expensive. But we have to look at it in terms of, measure it against the expected earnings growth. And that will be reflected in the relative standing of forward PERs to current year PERs. Let's see how that is panning out. The implied earnings growth in the difference between the forward and the current year PERs stands at about 14.5%. So using Peter Lynch formula for assessing what's an appropriate PER, we can see that the PER currently stands at 14 times, and the earnings growth implied is 14.5 times. So the stock market actually has a little bit more of upside. So it can go to 14.5 times PER. From where it stands right now, it's 14 times PER. It can go to 14.5. So the picture from this valuation perspective, is that there remains a little bit of further upside for the stock market. What does the valuation picture look like from dividend yield? The average dividend yield for Bursa Malaysia currently stands at 3.3%. That's 3.3% over here, yes. 3.3%. 3.3% is, did I make a mistake? Well, it's held at approximately this kind of level, I think it's probably 3.49 or 59%. Maybe I made a typo.